Good afternoon, and thanks for joining us for our Corn and Soybean Outlook webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me is my colleague, Dr. Michael Langemeyer, who's the Associate Director of the Center for Commercial Agriculture and also a professor in agricultural economics here at Purdue. We're going to spend some time talking about some of the information that USDA released yesterday, namely the Prospective Plantings Report and the Grain Stocks Report. But we're also going to do a more in-depth analysis in terms of what's taking place in these markets and the impact the COVID-19 scenario is playing out in these agricultural markets. So with that, let's do a quick review of what USDA released yesterday. They came out with the planting intentions and grain stocks reports, and there were some surprises relative to what the trade was expecting coming in. The corn stocks estimate was smaller than the trade expected. They came in with an estimate of 7.95 billion bushels. That was about 184 million bushels smaller than the USDA, or than the pre-release estimate of a wide variety of analysts across the industries were expecting. And that likely implies that the size of the 2019 crop was overestimated. That remains to be seen. USDA is going to release an updated number on that later this spring after the harvest is finally completed in some of those northern Corn Belt states. But odds are pretty good that that kind of a magnitude of a shift in the grain stocks is probably associated with overestimating that 2019 crop. And we'll see how that plays out later this spring. The corn planting intentions were somewhat larger than expected. They came in at 97 million acres. That was almost 3 million acres more than the average pre-release estimate. Most people were expecting a number somewhere close to 95 million acres. So that was a bump relative to what the trade was expecting coming in. And the soybean planting intentions were actually somewhat smaller than expected, coming in at 83.5 million acres. That was about 1.5 million acres below the average pre-release estimate. If you look at the corn numbers from kind of a historical standpoint, it puts us back up very close to the record large corn acreage we've seen, at least in the post-World War II era, at that 97 million acres. We were a little bit above that back in, I think, 2012, but still very, very close to that level and up substantially compared to last year. Last year we were at 89.7, and of course that was influenced by the severe weather we had in the spring and early summer of 2019.
And actually corn was up in almost all the major states. I think one exception was North Dakota. North Dakota expected corn acreage was lower than prospective plantings last year, but that's about the only state that was like that. And so one of the things that was very evident from this report, if this plays out, there's going to be a substantial more continuous corn. Particularly looking at the western Corn Belt, Nebraska, Iowa, Minnesota. Looks like there's going to be quite a bit more continuous corn in those areas than there has been in recent years.
And that's a good point. I think some of the analysts following the report question whether or not that would really materialize, and we'll talk more about that later when we get into some of the budget that you've prepared, looking at the relationship between corn and soybeans, especially here in the eastern Corn Belt. Looking at the soybean planting intentions, that was an increase of 7.4 million acres compared to 2019. And as I indicated a few minutes ago, a little bit less than people were expecting. People were expecting that number to bounce back closer to about 85 or so million acres. So it remains to be seen whether or not that's going to materialize. We're going to take these numbers pretty much at face value when we do our analysis, but that's going to be one of the debates going forward as to whether or not farmers actually shift their planting intentions as we head a little deeper into the spring and really approach planting season here in much of the Midwest. So one of the questions people always like to ask is, well, does this really make sense? And the way I like to look at that, Michael, is to take corn, soybean, and wheat acreage on a combined basis and look at that from a longer term perspective and say, how do these acreage numbers match up? When you do that, I think the numbers make a lot of sense.
I think they do too. I mean, we're very similar to what we were from 15 to 18 in terms of acreage for corn, soybean, and wheat.
Yeah, so a big bounce back compared to last year when we had so much prevented planting acreage out there. But I know some people I saw some comments immediately following the report suggesting that they were maybe kind of poo-pooing this report a little bit. But when I look at the total numbers, I think they make a lot of sense. I think that 225 is probably going to hold up. That's not to say we can't see some adjustment take place with respect to the breakout of corn versus soybeans later on, but I don't expect to see big changes.
And I don't expect that 225 number to change that much. I think that's what you were saying. If you see a 1 to 2 million increase in soybeans and taken away from corn, that wouldn't be all that surprising. But it would be a bit surprising that 225 million acre number to change very much from this report.
Yeah, unless we see a repeat of what happened last year, we don't want to forecast that
Don't
at
even
this
talk
point.
about that.
So let's look at the yield numbers and think about that a little bit, because we're going to use that to make some inferences about what production numbers are going to be. If you look at trend yield, and I estimated the trend yield going back to 1996, if you look at the trend yield for 2020, it comes out using that model of about 177 bushels per acre. Different people are going to use their trends off slightly different time frames than that, so not everybody's going to come up with a 177, but they're going to be pretty close. And if that happens, that would be a new yield record. And I think that's kind of interesting that the trend alone would give us a new yield record. That's an unusual situation to see that happen. So if you look at it on the soybean side, using the same kind of analysis, estimating a trend going back to 1996 again, the trend yield comes in at just below 50 bushels per acre. That is not a record. The record is 52. But still a pretty strong yield number and well above where we were last year. So trend yields combined with those large acreage numbers we just mentioned suggest some pretty big production numbers. And if you look at corn production potentially coming out of those planting intentions using trend yield, that potentially would give us a corn crop estimate here in 2020 of 15.8 billion bushels. Record large. Our previous record was not quite 15.2 billion bushels back in 2016. That's a lot of corn.
Yeah. The natural question is where's all that corn going to go?
Yeah, that's going to be an issue if that really materializes. If we really get that kind of an acreage planting here this spring, see reasonably good weather conditions and hit the trend yield number, that's a lot of corn.
And even if you back off 1 to 2 million, you're still looking at a lot of corn.
That's right. Yeah, so even if you back off the acreage,
yes.
Yeah, that's what your point is, right? That's a good point. On the soybean side, if you look at the same kind of analysis, even though we don't have a projection for the trend yield that would set a new record, that combination of boosting acreage and trend yield still pushes us up over 4 billion bushels, almost to 4.1 billion bushels. We were at close to 4.4 a couple of years in a row, so it's not quite to that level, but still that's a lot of soybeans as well. So maybe the soybean side doesn't look quite as severe, looking at that chart, Michael, as the corn side, but nevertheless, a pretty big boost in supplies across both of these markets. So let's take a look at the demand environment. So, one of the things that's really changed since the last time we did a webinar earlier this year, Michael, is the fact that the COVID-19 is really impacting the world economy, not just the U.S. economy, and that's really weakened the demand environment for these ag commodities, especially corn. So we're going to talk about it in really 3 different ways: ethanol demand, export demand, and feed demand. And let's take a look at that real quickly. And I've got ethanol up there as number 1 for a reason.
Yes.
Because that's where the biggest impacts are. So what I've got here is a chart that's actually based on some data that Iowa State University's Center for Ag and Rural Development publishes, I think, on a weekly basis. But these are estimated daily ethanol plant margins in Iowa. And I've just plotted them going back to September, so really for just this crop year. And obviously the greens are when the margins were positive, the red is when the margins were actually negative, and you can see what happened here lately as we've really seen the impact of declining oil prices, pushing gasoline prices lower, and that's really put a lot of pressure on these ethanol margins. And really, actually, as you look at it around the industry, a lot of discussion about a number of plants getting ready to shut down. So we're really going to see a big impact on the ethanol market and turn the corn market here the next few weeks, it looks like.
And what's really worrisome here is we all know that corn prices have declined substantially in the last 2 to 3 weeks. The margins are still negative.
Yeah, that's a good
even
point.
with those lower corn prices. So that means maybe they haven't, if those margins persist, those negative margins, corn prices haven't declined enough.
Good point. So if you look at that chart where I've got that negative 12 cents, that was a few days ago. That was, I think, early last week. And if you want to translate that and think about what that means in terms of corn, that's a negative 12 cent per gallon of ethanol produced. There's about 2.9 gallons of ethanol that come out of a bushel of corn. So multiply that by not quite 3, and you've got a 30-cent loss per bushel going on there, per bushel of corn processed. So one way to think of that is to say you'd have to reduce corn prices relative to where they were last week by over 30 cents a bushel before that ethanol plant would have broken even. That would have pushed corn prices in Iowa below $3.
Below $3,
right?
yeah.
So that's really the challenge the industry is facing, a lot of downward pressure there. And what's going to take place, we think, is simply cut back on ethanol production as these plants begin to shut down. Some of them have already shut down, but we're going to see more shutdowns here over the next few weeks. And how long they continue is going to be critical. And so if you think about what the impact might be.
And just a reminder for the listeners out there, you probably have more precise percentages, Jim, but approximately 35 to 40% of all U.S. corn is used for ethanol production. So when you have a blip, that is huge.
Yeah, so in recent years, exports and in recent years, feed demand and ethanol demand have been about equal, about 38 to 39% of corn usage going to those two categories. So on a combined basis, feed demand and ethanol demand accounting for just about, not quite, but just about 80% of corn demand. So as you think about the ethanol numbers, I've got the annual consumption numbers up here on the screen. And as you look at it, in recent years, we've been bouncing around between about 5.4 and 5.6 billion bushels. And I've got the USDA's most recent projection from just a few weeks ago for the 2019 crop year. But if you look at what's taking place right now with these ethanol margins and the potential to shut these plants down and have them stay offline for an extended period, it's possible we could drop corn going into ethanol by in the ballpark of 400 million bushels. That's a ballpark estimate. One of our colleagues here at Purdue at the GTAP Center, Farzad, put this together just in the last couple of days, doing some model runs. And there's a lot of variability in those runs, so I don't want to play that, peg that number too tightly, but it is significant.
Yes, and that was not his most pessimistic scenario. His most pessimistic scenario was even slightly lower than that, I believe.
Yes, a bigger reduction. Yeah,
a bigger reduction. So.
And our colleagues at the University of Illinois have looked at this. I think they've come back with a somewhat smaller number than what I've got on the screen. The difference really arises because of how quickly you think we get back to normal. Our colleague Farzad looked at this pretty carefully, and I think one of the things that he's looking at, and I agree with this, is the idea that if we see these plants shut down now, it's partly because of weak economic factors as well as what's going on in the oil markets, and in turn the impact that's having on gasoline prices. That's not going to go away overnight. And so as you think about it, the impact from a worldwide recession is going to be felt not only the next month or two, but continuing into the summer and perhaps even longer than that. So with that thought in mind, we think the impact on the ethanol market and in turn the impact that that's going to have on the corn market is pretty significant and one that we didn't expect earlier. If you go back to that previous chart I had, those ethanol margins looked pretty good in late November, early December. And all of a sudden here we deteriorated, even a little bit before the COVID-19 situation broke loose, we were deteriorating. But this has really driven it into the red and making a big difference. And you can also see the impact of what's going on in the ethanol market with respect to basis levels. We've had some extraordinarily positive corn basis levels here in the Eastern Corn Belt. This is from the crop basis tool that we have on the Center for Commercial Agriculture's website. Our colleague Nathan Thompson updates this every Friday, so these are weekly estimates. And you can see how sharply that Eastern Corn Belt basis has deteriorated lately. This is for Tippecanoe County, but I looked at several other locations here in the Eastern Corn Belt, and we were seeing similar declines in that basis level, dropping off very sharply, actually starting to approach the 3-year average. And of course, we've been above that 3-year average going back to the beginning of harvest last fall. So that's really having kind of a double whammy here in the Eastern Corn Belt. We're bringing down the market clearing price for corn in general, but we're having extra impact here in the Eastern Corn Belt in terms of these basis levels really collapsing.
So it certainly makes it more challenging for those that do have grain in the bin deciding what to do with it.
Yeah, very much so. So if you look at it on the export side, that was our second demand component we wanted to look at, and that is If you look at USDA's forecast coming in, they were still forecasting that corn exports would decline about 16% compared to 2018. But if you look at year-to-date sales and commitments through mid-March, they were down about 28%. And normally on these kind of charts, Michael, we would sit here and debate, well, are we going to be able to catch up? I don't think there's any debate on this one.
No.
Given what's going on in the world economy right now, the odds of catching up are essentially zero.
Yeah, slim to none.
Slim to none. So I think that's a key point going forward. It's going to be extremely difficult to catch up. In fact, we just don't think it's going to happen. I don't know if we'll continue to be down that 28% that we've been down so far, but I kind of think that's a pretty good estimate. So that's the number I've actually been working with.
So far we got kind of a negative impact on ethanol, negative impact on exports, and now you're going to turn to feed.
Yeah, so this is the bright spot.
This is a bright spot.
We do have record large meat production in the U.S. in 2020, and that's going to continue to support feed demand. That's the positive news. And I know some people are talking about negative margins, especially in the beef industry, and I think it's important to think about when that might have an impact. If we do start to see some liquidation take place in the beef industry, and we haven't seen any evidence of that yet, but if we do, those spillover impacts are going to be farther into the future. If you think about feed demand here in 2020, the fact that those animals are still out there producing and are likely to continue to produce throughout the remainder of the year suggests pretty positive feed demand. So that's the positive side. We mentioned earlier that the ethanol and corn feed demand have been essentially running neck and neck. You can kind of see that in this chart. USDA is still forecasting feed demand to be a little bit larger than last year. It is interesting, Michael, though, that even with those record large animal numbers, if you go back, that doesn't take us back to record large feed consumption. We saw larger feed consumption numbers back in 04, 05, even 07. You and I were talking about that this morning. Part of that is an indication of just how efficient we've become.
Definitely, and that's all species. I mean, it's not just poultry and pork; it's also beef.
Yeah, we're doing a better job.
Really improved efficiency over this last 15 years.
We're doing a better job at converting feed into meat than we used to, and that's being reflected to some extent in these charts. But that's still a positive. If you look going back, for example, to 2012, when feed demand was only 4.3 billion bushels. So. Still a positive, but that's the only one out there really from a demand side. So let's kind of summarize. Corn production in 2020 could set a new record. Near term, we see a pretty sharp decline in ethanol demand, and that's going to linger, we think, until the economy really shows signs of recovery. We're cautiously optimistic that that might start to show up this fall, but that doesn't give us much help between now and the end of this crop year. Exports were running behind USDA's forecast before COVID-19 hit. The global recession that we think is underway now means exports are unlikely to catch up. And if you think about what that means, the weak ethanol and export demand means carryover from 19 into 20 will increase more than we thought it was going to be just a few weeks ago. And then the only bright spot we just mentioned is the feed demand side, and that's not going to be enough to offset those big negatives coming out of the export side and that large decline in ethanol demand that we're seeing. So if you think about it, looking at ending stocks as a percentage of usage versus marketing year average prices, I've got the most recent WASDE numbers on the screen in that chart. If you look at the 19 projection that USDA had out, they were looking at a carryover of about 13% of usage going into the 2020 crop year. We think weak ethanol demand and to some extent maybe declining exports could push that up closer to 17 or even 18% depending on how weak the exports are. Michael, if you look at the prices on that chart, if we get carryover above 15%, what does that start to suggest about marketing year averages, especially looking ahead to 2020?
Yes, we were looking at 335 corn in 16-17. You're looking at something below that for 2020.
Potentially.
Potentially.
Yeah.
Because you start, you get 17% as the carryover coming into 20, and then you add to that a very large crop. You're looking at some pretty large carryovers for 2020 potentially.
That's right. And so the marketing year average for 2019 won't drop that sharply because we've got so much of the 2019 crop year behind us already. But still, if you look at USDA's most recent projection was 380. I think that's probably going to fall to 360 or maybe a little below 360 before this plays out. So that's going to be lower as well. What about on the soybean side? Really, key points there are export demand and crush demand, and you can kind of guess where the crush demand's going based on the livestock numbers we've already presented. But let's look at the export side in some detail. So here's USDA's soybean export numbers. Again, these are coming off the WSDA report from a few weeks ago. Still forecasting a 1.83 billion bushel export number. However, if you look at it, year-to-date sales and commitments were 14% below that through mid-March. And it's going to be tough to catch up on this one as well because of the weak world economy as a result of COVID-19. So we're not optimistic about seeing those export numbers realized. We think we're probably going to see some weaker export numbers than what USDA had in the most recent WSDA. And that suggests larger carryover going into the 2020 crop year as well. So if you think on the soybean side, large production increase coming out of a combination of acreage and a return to trendline yields. Exports are running below the pace needed to hit the USDA target. Domestic crush demand is probably going to remain pretty strong based on those livestock numbers that we talked about. But that does mean a larger carryover from 2019 into 2020 than what we were expecting just a few weeks ago.
But not as much as the corn carryover.
Not as dramatic.
I mean, because of the 76 million acres that was planted in 2019, a huge drop, of course. The carryover did get close to 10%.
Yeah, right
before
at 10.
this,
Yeah,
before some of these numbers.
So let's look at it. This is, again, the carryover as a percentage of usage, the ending stocks as a percentage of usage against market year average prices. And so as you look at that blue bar on the far right, that was USDA's estimate from just a few weeks ago. And as Michael just indicated, expected carryover of about 10% or maybe just a touch over 10% relative to usage. Weak export demand could push that number up closer to 15%. We'll see how that shakes out. That's going to be one of the challenges. And that means a marketing year average price for the 2019 crop down from the 870 USDA was projected a few weeks ago to maybe closer to 850. And then as you like to point out, Michael, if you start looking at that chart and thinking about what a 15% decline means, that suggests some relatively weak soybean prices in the 2020 crop year. Now, the big caveat on 2020 on soybeans is we don't know what's going to happen with respect to China.
Yeah, we don't know how the phase one trade agreement is going to play out.
So far, everybody's kind of pushed that back a little bit because of the COVID-19 situation in China. We don't know how that's going to play out. If they do see a significant recovery, some combination of either larger pork imports, larger soybean imports as they start to try and rebuild their hog herd. There's a tremendous amount of uncertainty about what exports are going to do off that 2020 crop. But here in the short run, it's tough to get real optimistic about the soybean export numbers here the next few months as we wrap up the 2019 crop year. So, Michael, let's talk about some net returns.
Okay, let's shift gears here a little bit. I want to talk about a chart that illustrates net farm income for a case farm. And just remember, to calculate net farm income, we take gross revenue minus cash expenses and depreciation. It excludes all opportunity costs. Those are included when we look at earnings and net return to land, but they're excluded when we're looking at net farm income. And so it's just the cash expenses and depreciation for net farm income. We also want to look at net return to land, compare that to cash rent, talk a little bit about what might happen to cash rent moving into 2021. How those negotiations might go later this year. To calculate that number, net return to land, we take gross revenue minus cash expenses minus depreciation. But in this number, we include opportunity costs. We include opportunity costs on labor and machinery ownership, but we exclude the opportunity costs on owned land. And then earnings is including all the opportunity costs. And so there's quite a bit of difference in these terms depending on what you include. So this is the for the West Central Indiana case farm, and the main reason I showed this is to take a close look at 2020. I think the only word for this, Jim, is 2020 does not look really very good. The crop net returns actually look negative, plugging in very recent future prices adjusted for a historical basis. The government payments from Ark County and PLC for corn and Ark County for soybeans are going to help a little bit, but still that net return is really low, even compared to the low returns we've seen since 2014. So that's very obvious. 2020 returns were not very good before COVID, the COVID problem, but it's dropped probably $30 at least, in the last 2 to 3 weeks due to the lower prices.
So, Michael, on that slide, have you revised your estimate of government payments based on the decline of prices?
Yes, I have, and so I've got the Ark County and PLC payment for 2020 included there. There's a potential for a PLC payment for corn and a small Ark County payment for soybeans.
Okay. So let's look at the difference in earnings per acre on corn versus soybeans.
Yeah, this has changed a little bit in the last 2 to 3 weeks. I've been showing this slide all winter, to extension audiences, and when I showed it this winter, the 2020 bar was slightly green. It was above zero, meaning that corn was slightly more profitable than soybeans, but not by very much. That's reversed here a little bit. Now it looks like soybeans are slightly more profitable than corn. But let's put this in perspective. We're nowhere near the situation we were at the start of the ethanol boom, when from 2007 to 2012, corn was extremely competitive compared to soybeans. But we're also nowhere near the situation we were in from 13 to 18, where the export demand for soybeans was growing very rapidly, and soybeans were more profitable than corn. And so we're really looking, this is more for Indiana, Eastern Corn Belt, we're really looking at a situation where the profitability prospects are very similar. And that's given the fact that we've had a lot of weakness in corn recently.
So earlier we were talking about the acreage numbers, and you mentioned the fact that some of those Western Corn Belt states were showing some relatively large increases in corn acreage. This is an Eastern Corn Belt budget. As you think about the Western Corn Belt, does that situation change a little bit? Is it going to favor maybe more of a shift out there?
Based on these numbers and looking at some of the budgets from the Western Corn Belt, I think a shift from 1 to 2 million acres from corn to soybeans would not be surprising. A shift larger than that, I just don't see. I could be wrong. I've been wrong a lot in the last year, but I think the number crunching I've done, it's just not that big a shift when you're looking at the relative prices and relative profitability. Now the caveat here is I personally think there's a lot more downside on corn price. And so that's the real caveat. How are people going to think about that when they're making decisions on acreage?
So I guess two things to maybe come out of that, Michael, as I think about it. One is if we see a shift in acreage, the acreage shift would likely be away from corn towards soybeans. And you're not expecting a large one, but
1 to 2 million.
But we probably would see some acres drift that way, is maybe one way to think about it. As people are sitting kind of on that bubble trying to make up their mind, that's going to be the direction they're going to lean.
And if you look at the prospective plantings report, in most of the corn states, you're seeing more continuous corn. And so all we're saying is we're not seeing a shift away from that completely, but just a small shift. Corn is less competitive than what it was in early March because of the drop in corn prices and the weakness in ethanol demand. But it's not like all of a sudden soybeans became extremely competitive, and that's the main thing I wanted to illustrate with this chart.
And I think one thing that might maybe facilitate that a little bit is the fact that given the weather conditions last fall and even so far this late winter and early spring period, there hasn't been much of an opportunity to do field work in terms of putting on fertilizer, et cetera, which sometimes kind of locks people into their acreage intentions. That really hasn't happened, or maybe less so than typical. So that might facilitate a little bit of that acreage shifting. But again, we're not expecting a big acreage shift. And you think about the total numbers that we showed early on, it's probably going to be a 1-to-1 shift. An acre that comes out of corn is going to go straight into soybeans. So, but we don't think there's going to be a lot of that take place. So you've looked at current prices and tried to compare that to what kind of a corn price you would need to make it balance out. And that's kind of a complicated slide. I'm going to let you explain that.
Okay, first of all, this is for the Eastern Corn Belt. This would look different in the Western Corn Belt. Specifically, corn would be more competitive in the Western Corn Belt because of the relationship between corn and soybean yields in the Western Corn Belt compared to the Eastern Corn Belt. So what I've done here is I've taken the Purdue crop budgets and I've used the yields from them budgets. From those budgets, I've used the cost for corn and soybeans from those budgets, and then I've asked the question. If soybean price is we have a specific soybean price expectation, given the cost, given the relative yields, what would corn price need to be to encourage us to produce corn rather than soybeans? Think about this one as in 2019 we had corn acres, and so we're deciding whether rotation soybeans is more profitable or continuous corn. And so if you look at this and use 850 soybean prices, that's a little stronger than they currently are, the current expectation, but let's just use that as an example. If you have 850 soybean price, even for the high productivity soil, you'd be looking at some relatively large corn prices. And so I don't see a situation in the Eastern Corn Belt where there's going to be a substantial amount of continuous corn. Now let's go back to the prospective planting numbers. Indiana had 5.8 million acres of corn in that report and 5.4 million acres of soybeans. I would not be surprised if that doesn't come closer to 50-50 based on these numbers. These numbers did look different when I was doing extension meetings in January and February. Continuous corn still didn't look like it was extremely profitable, but it was much closer to being competitive compared to what the numbers look like in early April.
Yeah, so based on the numbers you've got on the screen there, Michael, looking at some pretty even low soybean prices all the way down to $7.50 on the high productivity, you'd still need a $3.50?
Yeah, you'd still look at rotation soybeans.
Yeah, it doesn't look very good. All right, so let's look at the rotation budgets and see what that looks like.
Now, let's preface this by from 2014 to 2018, there was quite a bit of continuous soybeans in Indiana, and even more so in Ohio. And so let's talk about this slide with that in mind. And so what I've done here is this is ground that was soybeans in 2019, and so we're looking at second-year soybeans versus rotation corn. Again, using the Purdue budgets or looking at the Eastern Corn Belt. And so in this situation, an 850 corn price, we would need an 850 soybean price. We would need a corn price above 352. Now the prices right now are weaker than that, but again, a lot of people like to use a corn-soybean rotation. So the fact that this slide is suggesting that perhaps second-year soybeans are more profitable, it's not that much more profitable. Again, going back to 14 to 18, there was a lot more incentive during those years to plant second-year soybeans than what's being illustrated in this table.
And you kind of showed that with that chart earlier when you had those big red, right?
I don't think the difference. To make a long story short here, I don't think the difference here is big enough to see a lot of second-year soybeans.
Good point. Okay. All right, let's look at cash rent and net returns to land.
This is one of the really tough ones to get a handle on. Is what I'm trying to do with this slide is talk about what is going to be the impact of cash rent and net return to land if crop prices remain relatively low. And so using the current futures price adjusted for historical basis, I've estimated net return to land for this case farm in 2020, and the news is not good. You're looking at a net return to land of about $130. That's substantially below 18 and 19, but it's also substantially below cash rent. If cash rent is not adjusted in 2020, which it's not going to be. 2020 cash rent's already set. And so I think that difference is big enough, even though even if we return to $200 net return per land in 2021, I think that difference is big enough to cause some reduction in cash rent, maybe as large as 5% moving into 2021. I just don't see how you can keep cash rent steady like it's been since 2016 after you've had a year like 2020.
So for clarity here, equilibrium on that chart would be when the bars are essentially equal to the triangles,
Yes.
right?
Long-term net return to land is equal to cash rent. And if you look at a inflation-adjusted net return to land, going back to 96, for example, you'll see an inflation-adjusted number of $200. We're looking at cash rents you're still at $240. And so unless there's some reason to expect our net return in 2021 and future years to get back up there to the 240, we're looking at some downward pressure on cash rent. And I wasn't so worried about 2020 number as long as that net return to land was around 200, which it was in January and February. But now with recent prices, I think we're looking at some adjustment to cash rents.
So we don't have the numbers on the screen, Michael, but that green bar, instead of being up close to 200, is now about 125, 130. Yeah. So a $65 or $70 drop in the last couple of months based on your projections.
Yeah.
Big move there, right?
Big move.
Yeah.
Now, I don't have a slide for land values, but land values may not move have as big a movement as cash rents for a couple reasons. Obviously, cash rents and net return to land is very important for land values, and so if net return to land is relatively lower, that would put downward pressure on land values. But what makes land value different than cash rent is we do have lower interest rates. The Federal Reserve lowered the interest rates again. That's positive to land values, and an already thin market has probably become already even thinner, given the uncertainty. I mean, if I was selling a piece of ground, if I didn't have to sell it in the next few months, I wouldn't sell it because of all the uncertainty. How often is that going to play out across the Corn Belt? I think we're going to take a thin market and make it very thin in the next few months. So keeping that land off the market is probably also going to help prop up land values. And so if cash rents go down 5% in 2021, land values may or may not see as big a weakness as cash rents.
And it remains to be seen how this plays out over the summer. I mean, we're still looking at really trying to absorb all the changes that have taken place here in recent days.
The reason we want to talk, we'll continue to talk about this in future webinars, is that the cash rent negotiations take place in 2021, and so I think it's important to keep these kinds of things in mind, as you get closer to that, so you can do a good job negotiating cash rents.
Yeah, because some of those discussions will be starting here maybe shortly after planting season.
Yes.
Truthfully. So okay. All right, let's kind of wrap up here with some marketing strategies, and unfortunately we don't have any magic bullets. If you look at it from a seasonal perspective, and we've talked about this in some previous webinars and certainly the marketing workshops that we've done the last couple of winters, there's a strong tendency to see a spring planting season rally in both corn and soybeans. And if that materializes, take advantage of it. That's your opportunity potentially to make some cleanup sales of the 2019 crop and perhaps make some sales on the 2020 crop as well. We don't know if that's going to happen. There's a very strong seasonal tendency for that to happen, but this is a very unusual year. The Eastern Corn Belt did benefit from some really strong corn basis for most of the 2019 crop year so far, but weak ethanol demand has really changed that dramatically, and we showed that earlier with our basis chart. I don't see basis bids strengthening unless something changes from now as we head into the summer months. So that would be our normal pattern, would see some seasonal strength in those basis bids. I don't think that's going to take place this year, unfortunately. Soybean basis, however, has remained pretty strong. And so I would encourage people to think about taking advantage of that basis strength and lock some of that in. As you look at the 2020 crop, that basis strength goes away. So that basis strength is really tied to what was taking place in the 2019 crop. Don't let that get away from you. And then as you look at the futures market, at the moment there is really no carry in the futures for corn or soybeans, no significant carry, so not much incentive to continue storing. And we've done some work in those marketing workshops, Michael, talking about the risk of storing into summer. That's always a risky strategy, and that continues to be the case again this year. So.
And just a couple comments related to finance. with these marketing strategies in mind, of course, it's very important to look at working capital. Do some contingency planning, use some pro forma financial statements. We've got an example of a spreadsheet on the Center for Commercial Agriculture website that you can utilize, or develop a similar website, a similar spreadsheet yourself. But do some contingent planning. What do these prices mean for my working capital next fall? Use that along with your marketing strategy to make sure that your liquidity doesn't get very weak as a result of these low prices. Another reason to do some contingent planning or using some pro forma financial statements is to take a look at your ability to repay debt. Think ahead of time. What do these prices mean in terms of my ability to repay debt? What's my plan B in making sure that I can make the principal and interest payments? Do I have a plan if these prices play out? And so this is a very important environment to do some financial projections.
Yeah, good point.
So it's not only marketing strategies. Take a look at your working capital. Take a look at your ability to repay debt and update those projections as we proceed through the year.
Yeah, and that's one of the things that we've tried to drive home at some of the workshops is the importance of updating those projections periodically during the course of the year. And this is a case in point. If you put together some projections back in December or January or early February, things have changed a lot, and you need to take a look at that and see what that looks like today and think about what
it's very close to where these marketing strategies. Let's say you're thinking about holding on to your 2019 crop. You think it might get better. Well, what does that do to your projections? You have to think about the risk associated with holding that crop longer, because I don't want to be Dr. Doom here, Jim, but there's a potential for some below $3 corn.
That's right.
And so holding on, how does that? If I hold my grain and corn is below $3, what does that do to my working capital? Can I afford to hold on? Do I need to market that crop now, to preserve my working capital?
Yeah, good point. All right, so with that, we're going to wrap it up. Our next Crop Outlook webinar will be on May 15th. That will be shortly after USDA releases the May WASDE report, the World Ag Supply Demand Estimates. That'll give us some updated information. We'll obviously have some updated information with respect to planning progress at that point. So more info and register at our website. I don't know if the registration is up at this moment, but it will be shortly. So you can register for the webinar, and we'll send you the
And hopefully quite a bit of our corn and soybeans will be planted by May 15th.
Well, and maybe prices will recover, but that doesn't seem very likely. So anyway, thanks for joining us. We appreciate the opportunity to visit with you. On behalf of the Center for Commercial Agriculture, I'm Jim Mintert.